Okay, so let's go into chapter. We have only one, but a pretty crazy one to cover. Um, okay, so the fourth objective is to learn how to use discounted cash flow models to make capital investment decisions. Do me a favor. Yeah, can you run a paper, please, and sign your names? Because I see that plenty of people are missing today, and we'll make this accountable. So can you run a page, someone? Oh, you will? Thank you so much. Okay, so make sure you sign. Okay. So we'll talk today about discounted cash flow models, and we have two of them that we need to learn how to utilize. It's your NPV and IRR. What are they? NPV is the net present value, and IRR stands for internal rate of return. Okay, so the problem is that the models that we've learned last class, they don't really recognize any time value of money. Okay, so neither payback nor rate of return recognize any time value of money. Okay, so which ones are recognizing? It's your net present value and its internal rate of return. Okay, so they do recognize time value of money. That's the main difference between these two. And obviously we do want it, when we're estimating what the next step to make in our business, we do want it to take into account what is the time value of money. All right, so both of those models compare amount of investment with its expected net cash inflow. Okay. So what is what is cash outflow and what is cash inflow? Cash outflow for investment usually occurs right now, right? It's that lump sum that you make up front, or maybe a first payment that you're posting, right? And then your cash inflow usually occurs in the future. Just from what it sounds like, it's the cash that flows into the business and the cash that flows out of the business. So the one that outflows is the one that's happening right now. Okay? So how do we deal with this situation? We have some cash that's something is going to happen to it in the future and something happening right now, but I need to make a decision right now. What am I going to do? I'm going to use this present value, right? The company is going to use present value to make that investment decision by comparing those two numbers, right? If I were to compare the amount of dollars that I will receive as a cash inflow years, right, or maybe whatever that time period in the future, it's not going to be that comparable if I compare it to today's money, right? So that's the problem that these two models are going to take care of. All right. So the definition, the net present value is the net difference between the present value of the investment's cash inflows and the investment's cost or cash outflow. Okay? So for us to decide which investment is more attractive, we need to find what is the net present value of that cash inflow, right? Between the present value of the investment's net cash inflow and the investment cost or outflow. So here comes another term, very important to understand. That's your discount rate. So discount rate, and we'll see how we apply it in a minute, is your interest rate that discounts, or in other words, reduces future amount to their lesser value in the present or whatever, today, right? In this present period, today. So discount rate also uses your firm's desired rate of return. Okay? We know how to calculate rate of return, so we'll see how does discount rate uses this concept that we've just learned. And obviously, if I'm taking, if I'm engaging in a riskier business, right? If I'm making a riskier decision, my rate is going to be higher. Okay? So when we calculated last class with you our rate of return, we also learned that what rate of return lets us to investigate is whether or not we are going to be operating at a loss or additional income if we're doing well, if we are making this decision, right? So here is another definition for you, so to say, although it might not look like. But if my present value of investment's net cash inflow is greater, exceeding, right, the initial cost of investment, so this is going to be a good investment. What does it mean? Practically, you can also say that this rate of return that's required to us so that our investment is exceeding our expectations, okay, to be our calculations more than that, for us to accept this investment, okay, for it to be considered a good investment. So if I'm engaging, going to this higher the risk, higher the rate, going back to this notion, if I'm engaging in a higher risk investment, I am incurring higher rate, all right? So how does it look on the example? This is quite a lot of definitions, but how does it look on the example? So let's say I have to choose between two alternatives. Okay, I'm the Greg's Tunes, and I'm considering either I'm going to be doing CD players or DVRs, all right? So same story. We've been talking about this the whole semester. So now our manager, Greg, he needs to decide which of the alternatives are a better one for the business. Okay. So what we do know is that the product requires different machineries, and each machinery costs us $1 million, right? We've had that example last class. So what we also know is that the life of that machinery, 5 years. Expected lifespan, 5 years. We don't have any residual value. We'll just keep it at a 0 right now. But the two have different patterns as for how these projects are structured. So what do we see from here? We see that CD players, you remember, that looks exactly the same as the previous class, okay? It's the same story. But what I want you to see here is that the CD player generates much higher total cash inflow, right? But what happens with the DVRs? The pace is much faster, right? So which case should we use? Now here is where we're going to be applying that definition of the net present value, right? That modal. So as I said before, the net present value is the net difference between the present value of the investment cash inflow, right, and the cash outflow. Cash outflow is whatever we have to post this amount, right, the payment. And cash inflow is whatever I'm going to make in the future, right? So by installing the machinery for CD players versus the DVRs, these are the payments that I'm making, right? And at the end, when I'm starting to produce that product, is that cash inflow that I want to understand what is that net present value of that cash. Make sense? So let's see, how do we account for this new model? What do we do with this new model? Okay, so we see that CD players, right, if we're just looking at the column of CD players, we see that that project is going to generate $305,450 at the year, 1, 2, 3, and 5 years, right? So net cash inflow is the same for 5 years, right? So how did we call this last year, or last class? When it's the same period by period. What did we call it? Annuity, right? So this is an annuity. Now when we're looking at the, so what we're going to do here practically, we're going to use this table. Do I want to show this to you yet? Okay, I'll leave it here. We're going to use this table, right, that we learned how to use last class. And when we're looking at the DVRs, we see that the amount is not the same. So what's happening here? So let's go through the case with the CD players. We're going to use present value of annuity at $1. So we'll calculate our net present value the following way, right? So let's learn how we calculate the left side first. So we have 1 to 5 years, right? We'll identify what is the 1 to 5, what is our time period on the left. And then we'll try to calculate, we'll see how we calculate that present value of annuity of those payments, right? So we know that it's 5 years, it's 14%. I'm going to use my table, and that's what I'm going to find in the table. Right? I'm not going to go back to the table. We've learned how to use that right now. So I'll take that cash inflow of $305,450, and I'll multiply it by this factor, okay, that I got out of the table. So what is it going to give me? It's going to give me this present value. Okay? So I know that my initial investment is $1 million. Okay, that was my initial investment in that line of CD players, right? So the difference between my present value and this $1 million is this net present value of the CD player project. Okay, but this is only one part. I can't make a decision with this. Okay, so let's look what am I going to do with the right side. So the difference between the first and the second, like I noted, was that the first one had same payments year after year for 5 years, right? But that's not the picture with the DVR. invested, right? So I found my net present value of the DVR project. Okay, so great. I have these numbers, but what do I do next? What I'm going to do next, I'll try to make a decision. Okay, so I calculated some numbers. Now I need to make a decision whether I'm going to invest or whether I'm not going to invest. So the decision rule, invest in capital asset, goes this way. If the net present value is positive, then I will invest. And if my net present value is negative, then I will not invest. So what do I do? Both are positive, right? Both net present values are positive for two projects. So what I'm going to do, I'll choose the one that's greater. So I'll compare two numbers and I'll see which one is greater. All right. Yes, so it depends on the problem. You see, I hope if I'm investing 2 million, I'm not getting 1,078,000 at the end. So that's the problem, right? Here we're making money, but if you were to lose, then you wouldn't be comparing them. So for the purpose of the exercise, it's greater, right? Didn't we have last class something that was lower, right? Where we were not making any money? So it just depends on how the problem is set up, right? Yeah. Uh-huh. I'm investing in $1 million in CD players, and then what did you say? Yes. Uh-huh. That's an inflow. Yes, that's your inflow. All right? Yes.
And vice versa, first year.
You get more than the other years, yeah.
Okay. I just want to
That's an
understand.
inflow versus outflow,
I just want to
okay?
understand the pattern.
The outflow was that investment. The inflow is what to 300,000, right? So that would be lower, okay? For the purpose of this problem, they're greater because we just need it. Okay, so where did we stop? Okay. um, so another issue that we want to understand here, we're saying that both are going to cost us $1 million, right? That's the initial investment for the two projects. Now, sometimes our resources are not the same for the two production lines or whatever that investment is, right? So then what are we going to be selecting, the first or the second? So here we're going to learn how do we calculate this profitability index that will tell us if the initial investment is different, right? If the resources are different, the investment is different, what are we picking? What out of those two are we choosing? So how do we calculate this profitability index? So what it allows us is to calculate what are we getting back for each dollar that we spent on putting this CD line in our plant, okay? So what it computes is the number of dollars with the initial investment of 125,000, which tells us that the net present value is 25,000, okay? That's given to you. We also know what's happening with the second one. It's 38,000 with So this profitability, yes. Well, that's what we're saying, that profitability index is going to tell me how much am I getting back per dollar that I spent, right? And if this is a line that's a better decision-making one for your business, then you go with this. And it's usually the profitability index that's used, okay? Now, these are the tools that you're learning. It's not, one is not necessarily saying you cannot use the other one, right? Okay? So net present value is one model, and it tells you simply the difference between your present value of net cash inflow and the initial investment. The profitability index tells you a little bit more, right? It employs this present value of net cash inflow, okay? So it's based on it. All right. So it returns $1.21 for every dollar we invest in the project C versus project A 20 cents and project B 19. So in fact, project B is the lowest in profitability index, right? And if we're using net present value, this is the first pick for us. Only if it tells you, and here is the residual value of this project, then you need to treat it in a certain way. You have to go get the PV factor and multiply it and then find your net present value. All right? So if the problem is asking you to find the total present value of net cash inflow or maybe your net present value, and it's giving you the present, it's not going to give you just the residual value, then you need to add it. If it's not saying anything about residual value, don't worry about it, okay? So once we calculate the residual value, we can calculate what is the total present value of net cash inflow. All right, and to calculate these, we're going to add the present value of the residual value to the present value of annuity. All right, so this is how we got this number, 1,100,510. So the next step, we need to figure out, all right, we had this initial investment. What is that net present value that will tell us what should we do with this project? So we'll subtract our investment, and we'll get the net present value. But that's not it. We also said that there is another model, and it's called internal rate of return. So we'll start right now talking about the new model. All right, we just talked about net present value. Right now we have a new concept. It's internal rate of return. So what is internal rate of return? So in other words, IR model, variable that project is. The cost of the investment is equal to the present value of the So here's what I know. I know that $5 million is equal to 305,450 multiplied by the factor. And the table that I'm going to be using is the one for annuity, right? So I also know that my n is 5. But what is break? That's what I'm looking for. So I'm going to take the million. PV factor. Turn. So this quantum rate of return for minimum, your minimum desired return. So you're not going to be able to find the one as close as possible, right? If you feel like okay. Two models. Just calculating kind of the using that. So just that way. As if in different directions and different. So this is how PV factor, right? Unless it's the okay, give you one to work with. So invest 13,000 so far they're spending. So the manager and now using straight line depreciation method, suspension to value of you need to do let me show you how to calculate through that. Customer per day. That's the confusion. Make sure that it's the same time frame. So now what you for is how many skiers this suspension permits. 150, 60 by 100. I'll get my average net cash inflow per day. But this is per day. Right? I need to calculate per year. So I'll multiply by the days, the additional days that I have per year. 142. 142 I have to apply for the so my average annual net cash inflow per year is 168. Great. So that's something we've done. And how do I answer my question? Our investment is attractive. So if you in the previous slide, what decision did we make with that project? We calculated that the average so what we want to do right now is to calculate the second part. So just to remind you, how do I calculate NPV? NPV, I'm going to take my present value of annuity, right, of equal amount of, let's make it equal. Okay, so you have annuity and you have a single sum. I gave you the PV factors here. So you calculate the NPV. At the end, you need to subtract the initial investment, right, to find the NPV. And then we'll calculate the IRR. Once you have the number, let me know. Here, write it down. Come in. I wonder if I could press it while I was putting it on. Alright, so everyone got the information down. So this problem is 2, and we're done here and there this problem. Strongly suggest you try it. I don't have the answers for this on this slide. Just check. Where is the video? Tell you if it's right or wrong. You might see this somewhere else. So you want to make sure you can ask me. Stop. Carefully, yes. It's in your book, right? Oh, I don't have the book with me. It's the back of your book. But you don't need this. I have it here, right? For the IRR, that's the one that you want to go back in the book, right? I think it's in the back. It should be in the back. Yeah, S21-2. Then you go to find the homework that's comparable to this, maybe? I don't know. Like, different. There might have different decimals, but they cannot be different. Yeah. All right. That's the same thing. No, I'm not showing this to you. I thought I deleted the slide. Okay, so 21, I will. But before both. See, it's an appendix B. You need to go to appendix B. Okay. cruel to they're not. uh, what we're going to do. I'm going to explain, I'm going to show you how to calculate this. Make sure that for the exam you understand how to calculate this too, okay? All right. NPV. NPV. I'm going to take the our inflow, right? Calculated it, and we'll by this factor that I'm giving you, 6.145, right? So to calculate, you take the number, right, that we just calculated, and you multiply it by the factor. It's a typo. It's a typo. Another problem that here. That's right. You're right. That's the correct one. So I changed the slide. Yeah, I'm changing the slides. Okay. So NPV, to calculate the NPV, the first portion of that problem that I want you to understand how you calculate it. Okay. S21-2, all right? You're going to take your initial investment that we just calculated. You'll multiply it by the PV factor that's usually given to you in the problem. That's how you get your total present value of that expansion. Okay? Now you need to calculate also that $1 is a residual value. So we have to do that, right? We said if it says that in a problem that there is a residual value, you need to add it to your, but not just add it as a bulk, just, you need to also do this PV factor value, right? So you multiply PV factor 0.386, right? So am I going to use the annuity table or am I going to use just the PV factor of $1? In the second case, residual. Okay, that's right. So multiply, and I get the total present value of the residual value, which I'm adding the input. Now what I need to subtract from this is that initial investment, initial amount of money that I spent. So I get the expansion. So whatever I invested up front, I need to subtract. So all my cash inflow is multiplied. I also had residual value multiplied. Then I subtract my initial investment. I do not multiply it by PV factor because it's right now, right? And then the net present value of the expansion. Okay? So how do I find the first one? We just went over this. To find my inflow multiplied by PV factor. I subtract my initial investment, and that's how I get my net present value. Okay. We make this conclusion that yeah, it's great because NPV is positive. Okay. So we use that decision rule. It's a quiz time, but let me finish this. Okay. So, uh, so if our second question, right? If I need to find this IRR, investment cost, I know this, right? I expect net cash inflow, and my PV factor. So I just as the formula states, then I'm doing calculations. What I'm going to do, I'm going to my expected annual net cash inflow to be left, right? I divide my investment cost by expected initial net cash inflow. And now I see this annuity PV factor. Right? What I'm going to do, I'll go to my table and I'll see, okay, what is this rate? Okay, so I see that you state exactly, right? You found 5.079, great. You already found that, okay? All you're right now trying to understand is it attractive or not. It is attractive because it's greater than 10 and I know that, okay? No exercise.